On July 15th, Securities and Exchange Commission Chairman Christopher Cox issued an emergency order to, in the SEC's words, enhance investor protections against naked short selling in the securities of Fannie Mae, Freddie Mac, and primary dealers at commercial and investment banks.
And what we're particularly concerned about is the potential for there to be maliciously manufactured false information that feeds into a run which is furthered by not legal short selling, but illegal naked short selling, where people don't even borrow the shares that they're supposed to deliver.
This may have seemed to be a minor development about an obscure financial regulation, but the reality is, this was an earthquake felt all around Wall Street and all across America. For the first time in a long time, it appears regulators are taking an active interest in real consumer protection and truly taking on shady dealings, corrupt practices, and the bad actors that have shaken many Americans' faith and many investors' confidence in our financial market economy. But what is naked short selling? And why should we care? Naked short selling takes place when investors sell stock without first borrowing it. In financial terms, the seller is naked those shares.
If investors are going to have to be able to rely on fast-moving information, they have a right to expect that it's probably true.
This move creates an artificially high volume of shares for sale and will commonly drive down a company's stock price. In a naked short sale, the transaction is never truly completed because the short seller doesn't really possess the stock in the first place. That means the seller cannot deliver the shares to buyers, which in market jargon is called a failure to deliver.
We'd certainly like to eliminate the abuses associated with naked short selling to the maximum extent possible.
After many thought the SEC had failed to deliver on its oversight and obligations, the Commission issued the order and summed it up this way. Today's Commission action aims to stop unlawful manipulation through naked short selling that threatens the stability of financial institutions. We will continue our vigorous commitment to investors by working within the SEC and in close cooperation with our regulatory counterparts to promote the continued health and vibrancy of our markets.
The system that we've got is built on efficiency, and so the reason that it's possible for there to be naked short selling that is not technically illegal, these prolonged failures and occasionally trades and shares that don't exist, is that for the system to operate, it's deemed necessary with end-of-day net settlement. But the shares and the issues that we're talking about here are in firms where there is substantial float, where it should not be a burden to locate the shares.
Many believe this is an excellent start, but they also believe the SEC must go further. Now, a national organization is determined to take this fight all across the country. American Entrepreneurs for Security Reform is making this pledge. If the limited and temporary rules banning naked short selling are not made permanent in 2008, they will organize campaigns in 19 states to achieve this fundamental reform.
This is one legacy.
Why 19?
19.
Because the SEC's emergency order mandates that to sell short the shares of 19 specifically named financial institutions, traders are compelled to arrange to borrow the shares. This would prevent the shorting being naked. ASR believes what's good for these 19 should be good for everyone. Once again, it's the SEC's move. If the Commission fails to act, it could soon be yours.